more on China's future. Leland Miller, president of CBB International, joins us live from New York. Leland, welcome back to the show. Good to see you. And let's start off with this. There's a lot going on, but if I was a client and I were to just ask you what's happening with China's banking system, how would you answer that?
Well, it'd probably be a little bit longer than a 30-second soundbite. But essentially, you're seeing a lot of growth in the economy. But that doesn't mean the credit mechanism is working very well. And you're seeing credit continue to ease quarter after quarter after quarter. But you also have a question about corporate loan demand. Are firms responding to that credit easing? And the answer is not really. You're seeing a problem over the course of many quarters. And because of that, all these high GDP growth numbers and others, they really have to be put into question because you're not seeing strong fundamentals all the way through the economy.
For the past couple of years, good news has been bad news has been good news, and it's quite confusing for a lot of investors. I'll just give you one example. We look at home prices. Every time we see numbers that the home prices are moving higher, there's this fear that that's bad news because there could be more controls down the road. Doesn't it make it very difficult to assess what's really happening with the economy, or at least where investors should put their money?
Well, I think that's exactly right. People have, what little data they have, they read wrong. And the best example of that's a GDP number. When the market looks at the GDP number, if it comes out and it's over 8%, then there's some cheers. People think China's doing a great job. If it comes under 8%, then there's some fear in the marketplace that what's happening here is China slowing down other problems. But what China really needs to do is slow down and have a slower, healthier growth, do a little bit of rebalancing, sectoral rebalancing, consumption investment rebalancing. So a slower number should be a positive signal, but people don't read it that way. And that's a real problem when you're interpreting Chinese data.
Leland, America had its own stimulus package after the financial crisis. China also came out with one very quickly after the collapse of Lehman, and it was substantial. And there was a lot of criticism, both inside and outside of China, that someone will eventually have to pay for it. What is the debt situation in China, both on the sovereign side and on the corporate side, and is it possibly being overblown by perhaps the media even?
Well, that's the $90 trillion question. No one really knows what China's non-performing loans are. The listed numbers, the official numbers are fairly low. I'm not sure the market gives them much credence. They're just too low to be credible. But there's not much transparency there. And so the only real way to get at the debt situation is to look what firms are doing on a quarter-to-quarter basis. And if firms are borrowing, if they're able to borrow, if you look at their rate, how they're accessing capital, what's the cost of capital, these are the things you can do. And it's a little bit difficult in a formal credit environment when loans are set, the lending rate set and the deposit rate set to get access to cost of capital type info. But if you look at some of the shadow lending and other things, you're able to get an idea of this.
Leland, one of the issues that's come up is with this new leadership, there's been a lot of talk and advice about what perhaps reforms they should focus on. In your perspective, in your experience, what should the new leadership focus on specifically with respect to financial reforms?
Well, I think that, of course, you can talk about floating the currency or floating interest rates. But if you're being realistic, in the next year or so, what you should do is work towards freeing up the lending rate, work towards freeing up the deposit rate, so you get a little bit more movement there, which is what they've been doing. But also creating a system that's not reliant on stimulus. For a long time, you had monetary stimulus fueling China's growth. Now you have fiscal stimulus, but you're getting to an end of the time in which you can keep pumping that kind of investment, those investment dollars in the economy. What they need to do is they need to have a system that incentivizes credit going to worthwhile firms. Firms that are not credit worthy, they should be dying out. But you have the problem with social unrest. It causes unemployment. None of this is pretty, and so it has to be done gradually, or there'll be a lot of confusion.
All right. Leland, not so simple. Leland Miller, CBB International. Thank you very much for joining us from New York.